trading friends, and welcome back to Forex Focus, brought to you by IG. Talking inflation again here in February as we have a higher than expected print. A lot of us thought the inflation story might be going away, but it has resurged here in the early part of 2024. There will be more data to come, but for the time being, it's caused quite a stir, especially for U.S. rates and dollars, and on down to stocks and commodities and everything else shifting in light of a number that at face value might not look too crazy. And we have here the headline inflation and the core inflation, the two big numbers, both of which the Fed wants down at 2%, both of which are not at 2%, and both of which outperformed expectations, higher than expectations by 0.2%. And you might think, well, you're splitting hairs here. It's 3.1% for headline inflation, 3.9% for the core. Both of them seem to be moving lower in the long term. But keep in mind that the central bank here in the U.S. has been very, very strict about getting this number down to 2%, which has been pretty much every central bank's target in the long term, is to have inflation at 2%, showing that the economy is moving in the upward trajectory, producing goods and services at slightly higher prices, growth, so to speak, as opposed to deflation, which might sound good in theory, but in practice is usually indicative of a struggling economy. And we haven't been at 2% for the last couple of years here, and everybody expecting that the Fed would be cutting rates here in 2024, and they continue to say, Jerome Powell obviously being the leader, that we are not devoted to cutting rates until we get 2% inflation. The job's not done. And so, as you would expect, a higher than expected number here across the board has resulted in strength for U.S. interest rates, which we'll get to in a second, but also strength for this U.S. dollar resurging here once again, especially in this dollar yen. You see the rally coming after the CPI data, over 100 pips of appreciation dollar over the yen, with the idea being U.S. interest rates above 5%, Japanese interest rates still negative, the equivalent, the overnight rate, negative 10 basis points. In the U.S., it's 5.25%. And if inflation in the U.S. isn't getting down to the 2% target, and the Fed isn't necessarily going to cut as soon as was expected, then there still is demand for this U.S. dollar relative to this yen if the gap of interest rates is still going to be negative 10 basis points to 5.25%, whereas at various points over the course of the last couple of months, there's been an expectation of 5, 6, even 7 rate cuts. And now you're seeing U.S. interest rates rise across the board. And we'll start by looking at the 10-year yield, and then we'll get to that overnight rate and the expectations for the Fed in just a second. But you see the price action here coming off of the event. 10-year yields getting back above 4.25% at year-to-date highs, at highs since pretty much November of last year. And this is a synergetic type move for interest rates in the U.S., right? 2-year, 10-year, 30-year yields moving higher off of this higher than expected inflation number. And with it, as I was speaking to, that overnight rate from the Fed, unlikely now to be cut at this next meeting. Looking at the odds, definitely at the next meeting in March, but also here now out into May, there's less than a 40% chance that the Fed would cut then even. Now, these odds fluctuate all the time. For example, yesterday they were 60% chance of a cut at the May meeting. And so this, of course, is going to shift plenty by May 1st, but immediately after this inflation comes out higher than expected, the odds go from more likely than not of a cut, of the first cut being in May, to now less than 40% chance of that first cut coming in May. And now you get a little bit more of the story of why dollar is running up so much, especially against that Japanese yen, because it's been a little bit more competitive between the euro area and the U.S., or the U.K. and the U.S., or Canada and the U.S., right? Because they hiked throughout the last couple of years with the U.S., and now it's a little bit of a competition of who's going to cut and when. If globally central banks do start cutting, now keep in mind, none of the major central banks have cut yet, including the U.S., whereas Japan never hiked over the course of the last couple of years. And so any inflationary strength and reason for interest rates in the U.S. to stay higher for longer is theoretically going to reflect in a big move here for this pair, just given that Japan has not been as competitive to the upside in interest rates. Now, the question becomes, will they price out the chance of a rate cut in March? Right now, it's low, but it's still, a 5 to 10% chance of a cut in March. And as you just saw, close to a 40% chance of a cut in May. Will they continue to price those out and shift these rate cuts in the U.S. even further out? Potentially, keep in mind, again, the elephant in the room, the U.S. doesn't have to cut until they get the inflationary measures and employment measures that they want. Could this U.S. dollar get through these 30-year highs? Right now, just a couple hundred pips away from those 30-year highs for dollar over yen. If these data points still reflect U.S. strength and U.S. rates staying higher, or was this number a one-off? And, in the grand scheme of things, inflation still moving lower. Maybe we'll get those 2% numbers over the course of the next couple of months. Maybe it's just a little delayed, and this U.S. dollar gives back some of the ground it's gained. But we'll see what happens. What you can definitely tell is, to kick off 2024, dollar strengthening once again. I mean, that has been a pretty mean month and a half here to start the year. The rise from almost 140 to now above 150 in this dollar yen. But plenty of information coming out of the U.S. and Japan throughout the remainder of the month. We'll stay tapped in, but there you have it. Inflation higher than expected, U.S. rates and dollar running up to year-to-date highs.